NQ, the 24th of April 2026 review. We are going to cover the weekly closure at the high that we have seen this week and why we expected TGF to fail and not come to fruition, and reasoning behind it. So it's the daily chart. We are above the initial autumn high, trading, having seen the market make a buy mode on the daily chart completed. Very textbook, very nicely looking actually on the daily chart. We are now above the original consolidation, and given that it's the daily time frame, we are going to expect further continuation to the upside. You don't want to pick it up in a higher time frame bull market, bullish institutional order flow. So we continue to expect the market to continue to trade higher above the original consolidation up to new highs. Looking at the 4-hour chart, we can see that we have left several relative equal lows behind on our way to the upside, and given that it's the autumn high protocol, the so-called autumn high protocol, that basically translates to ignoring these relative equal lows and not looking to short the market, trying to trying to target those lows. No, we are just continuing to look for buys set up to the upside, because the thing is, with when a market is in a buy program, especially particularly when it's trading above autumn highs or even towards autumn highs, you basically expect those lows to remain intact. That's the mindset you want to have, because the thing is, if you're trying to short it, attacking those lows, you see you get punished pretty hard, and this is very typical, especially when a market is trading above autumn highs, that those relative equal lows are being left behind, and a lot of traders get punished. Basically, anyone who tries to short it gets punished pretty hardly, and the market will just continue to gravitate higher and higher, leaving those lows behind. So what I basically do is I just ignore them, even though it might be counterintuitive, because in general you want to attack those relative equal lows, but context is crucial with that statement. And when the market is in a higher time frame buy program, especially trading above autumn highs, you just continue to side with the long side, and that's what I did. And I shouldn't give advice, but that's probably the right thing to do most often, because even if it fails, you it isn't because you were on the wrong side of order flow. You're trading with order flow. So most of the time it's literally just a tactical mistake, instead of just being just not aligned with the market on the higher time frame. So I ignored these relative equal lows on the 4-hour chart, and even more so because we have this new week opening gap on the hourly chart. So we've seen that the market consolidated throughout the first half of the week inside of that new week opening gap, and eventually took out one level of sell side, leaving this one behind. But that's okay, because we're dealing with the constraint, if you could say, of this new week opening gap. So the thing is, when you have such a new week opening gap in place, it is quite typical that you see the bodies stay within the boundaries created by the new week opening gap, and that's what we've seen here take place. It's the bodies that are staying within the new week opening gap, and only the wicks trading outside of it. So you see really the respect of that key level. Furthermore, that's also the reason why I particularly was only interested in one level of sell side and not this one, which is, as you can see, further outside of it. Could have taken that low out too, but it wasn't a necessity, because we were looking specific at the bodies of the candles. They are telling the story here, and given that we have this new opening gap, I would not look for that lower low to be taken out, because we have that new opening gap. If there was no new opening gap here, then I would expect this level of sell side also to be taken out. But because we have that new opening gap, I did not. So the market eventually moves outside of the new opening gap, taking out this level of buy side to continue to trade higher, then notice I'm talking too fast. I'm out of breath. But notice that we have this dealing range defined by this low and this high. Why these specific two levels? Because we took out a level of sell side liquidity here and a level of buy side liquidity here. So we have defined a dealing range from this low to this high. 50% of this is around here, so this is in a discount. Notice that it has an overlap with this bullish order block of significance. Why? Large BV candle took out sell side and a shift in market structure to making it high probability, coupled with the fact that we have a new opening gap midpoint here. So we have overlap of two key levels and sell side, so 3 and a discount. That's an level where you expect the market to repel from going higher, given that we are in a bullish market. So the market did so here, and then we are getting closer to today, which is around here, but still Thursday. We created this large, well, no, it's not large, but we created this new day opening gap of significance, and the market left it behind, never coming back down into it. I would classify it as a breakaway gap. That's what that's how I determined it intra-week on Thursday. Ideally, you don't want to see the market trade back down into it. If you would expect a rapid repricement higher that day or the very next one. Could have traded back down into it, yes. It would just not be as bullish to me, given that we have this consolidation here. So trading back down into it, it needed to repel quickly higher. Otherwise, I would not be that interested in longing further and just anticipated the market to fizzle out throughout the rest of the week. It didn't. It left it gap behind, creating, basically acting as a fuel on the fire, accelerating the move higher. Then to today, we moved higher. We go into that on a 50-minute time frame, but we moved higher, created a short-term high, it's tracing back down into a discount fair value gap. Notice the respect of the midpoint. That's what you want to see. Midpoint being respected with the wicks, and the body's ideally even staying above it, which is what it did here. A clear bullish indication that we're going to see another leg higher, expansion swing, retracement, and then a continuation higher. You could also impulse swing, then retracement and continuation for the expansion higher, but whatever. So I made a note here. It states that in a buy program, any discount array is expected to support price going higher at least until the draw on liquidity has been met. That's a general thesis. And then any discount array up to equilibrium of the implied dealing range offers high probability long setups. This is a pretty much copy of a statement in the market maker by model notes that I have. So that's the general thing which holds on any time frame. But the thing is, we are not in a general case. We have important thing to account for, and that is that we are trading above all-time highs. So then the all-time high protocol is in place, and it basically says that in a all-time high protocol, any discount array is expected to support price going higher, and then at least until when? Well, basically defined as two cases. Intraday, I would expect the market to continue to go higher then until time of day. So in general, that's going to be the PM session, and then even more specifically around 3 a.m. when the bond market closes. So I would just target that level of that measure of time. Generally, the market forms then the opposing end of the daily range on an up close bullish day. So that's then a reasonable target, a time to look for the target. And on the higher time frame, that's going to be in perpetuity. So basically, you just continue to expect the market to continue to trade higher and you continue to look for longs until it actually shows very clearly and distinctly its hand. So like major discount arrays are being broken to the downside, and then only if and only if that's the case, then you would look for downside objectives. But until then, you just continue. I just continue to look for longs intraday and expect the market to go higher in perpetuity. So until it really shows its hand, really, I will continue to do so. So never try to pick a top in bull markets unless you want to have your face ripped apart. Alright, 5-minute chart. So even though your idea is fine and it's well built on a solid foundation of the higher time frame, it doesn't mean that the price action itself is going to be anything cleanly, especially with the environment that we are in currently. The price action that we've seen this week, usually after a major level of liquidity has been cleared, in this case all-time highs, the market tends to be less clean in its delivery, and that's what we've seen this week. We saw a lot of back and forth movement, lots of long wicks with small bodies candles, generally indicative of I can already show you on the lower time frame, this type of price action, lots of back and forth, very uncomfortable, to me at least, to sit through. So we can frame a setup obviously with, again, a dealing range formed. I will not repeat myself, but if you have paid attention, you would see the reasoning behind the formation of this dealing range. So we trade back down into a discount. Is that hourly fair value gap? A market trade back down into it, respecting it and moving higher after taking out several measures of sell side here, 3 drives pattern, 1, 2, and then the drive higher. We traded back down into this rejection block and then finally repelled higher, but see how sloppy the delivery is here. Very ugly price action, really. Movement higher, trade back down into this breaker, previous area of distribution, coupled with a new level of accumulation. This fair value gap, high probability, long generally, but given the price action here, it was still very sloppy in its delivery. Then a pre-market buy-side liquidity or original consolidation was the target, and it has been met, and then the market pretty much fizzled out in a consolidation into the close of the week. Still grinding higher, but nothing of significance. So zooming in on the 1-minute chart, we had 10 a.m. medium impact news, not of much significance. You can see this buildup of buy-side liquidity here, relative equal highs, lots of it, and every time sell side was taken out, we saw a small movement higher, but pretty much quickly going lower again to take that previous level of that new level of sell side until that discount array has been reached, that 50-minute rejection block overlapping with lower time frame discount arrays. But you can see the movement of the buy model here on the 1-minute chart. You can see the general structure, but the delivery itself is very sloppy, and lots of time passes by before it eventually has delivered. I did monitor it and I did long it eventually, but I too got spiked out here and there, because you can do a ultra short ultra small stop loss in this kind of environment, because levels that generally are expected to hold might fail here because of those wicks spiking you out, and that's what happened to me here. I tried to long it in this area and I actually got tripped out. Well, given I did re-enter eventually, but and ride it out to the pre-market buy side, but it was less comfortable than it could have been in a more cleaner price action. Nonetheless, we saw it eventually deliver with this ramp up higher, and I really just closed it once it took out pre-market buys. I didn't really want to sit in it any longer than necessary. So that's the price action basically of the day. The only point of interest to me was what we're seeing here, and PM session was just a consolidation into the close. So why did TGF fail? I almost forgot that. Well, basically for the same reason as stated earlier, because of the all-time high protocol. So all-time high has been taken out, and you just expect continuation higher. Like I said, you're not looking for those short setups, and therefore you are not looking for a return back into the weekly range. Generally what happens is that it will just close at the high or just very, very close near it, and nothing back into the weekly range of 20 to 30%. So that's why I would say it failed.